Welcome. It's December 2023. We are looking back at November in the commercial real estate capital markets. I'm StackSource CEO Tim Milazzo. I'm joined by my colleague Chris Peters, director in our Chicago office. How are you doing today, Chris?
I'm doing good. It's a little chilly and dark. How about you, Tim?
We have a little glimmer of sunlight left, so it's 6 Eastern, 3 Pacific. If you're watching us live on LinkedIn on the West Coast, you've got still some sunlight left. But we're going to be talking about the end of the year, what we've seen last month in the capital markets, and what to expect in the months ahead. We're also going to be talking about what is this capital waiting for? We've had some slow months in commercial real estate capital markets, and we're going to be looking a little bit ahead to 2024 and what to expect. But first things first, let's look at what happened in the news in November. Chris, walk us through it.
Yeah, definitely. Had some really good GDP numbers come out. GDP accelerated at a 5.2% annualized pace, topping the initial 4.9% reading, and better than the 5% forecast that economists had were polled by Dow Jones. Great news for the economy. The economy is still chugging along given the high rates. So this is a benefit for the overall economy. There was actually a recent bank conference this morning where several CEOs of some of the largest banks really stressed that they think we're really in a soft landing, that we're already in it, and sort of the potential worst is behind us. So that's great news for the economy. What that means for rates, we don't know. Obviously, a fall in GDP or negative GDP would sort of boost the Fed to start cutting rates. So may not be great for rates, but for the overall economy, great news. Secondly, office is a dirty word. We've certainly seen a lot of office requests come through. WeWork and the bankruptcy with hundreds of locations across the country, really a tough thing for the office market to swallow. You're seeing a lot of vacancy, a lot of lenders not capable of financing office, and if they are, it's at very low LTVs with very stringent loan conditions. So office is definitely still a dirty word, probably going to be a dirty word for a while. But those are two highlights that we saw in November.
All right. As far as rate trends, we're mapping inflation at around 3% at this point, so a little bit above the Federal Reserve 2% annualized target. Treasuries and the continued yield spread between the 10-year and the 2-year. So we have an inverted yields curve. That continues. They are pretty tight. The 2-year and the 10-year are close, but they've also fallen. So we have a little bit of a trend downward in treasuries over the last 45 days. So they were highest, especially for the 10-year in October, and came back down through the end of November. Term SOFR has held steady for a few months here in a row. And so there's some stability with short-term rates over the last 4 or 5 months, and potentially a peak unless it hikes back up on the 10-year treasury side, with still some yields curve inversion, which speaks to expectations from bond market investors that we still may have a recession in store. As far as commercial mortgage rates in responding to SOFR and term rates, we're seeing rates in the low 6s again if you have an agency-backed multifamily product, or if you have a very low leveraged Class A property that might be able to attract life co-financing. Banks and credit unions are largely still in the high 6s through low 8s, depending on whether they price their loans over prime, treasuries, or through another mechanism. And debt funds, which are typically based on short-term interest rates like term SOFR, we're seeing rates between around 9% to all the way up into the low teens. So debt funds getting a little bit more expensive versus banks as treasuries are coming back down. On the commercial mortgage rate side, if you'd like to see this as far as up to date with today's treasury rates and today's spreads, you can always go to stacksource.com and click on the rates tab. All right. So, Chris, that's our rates. That's our news. How is it
Yeah.
affecting deal structure and capital options?
Yeah, good question. And to piggyback off your comment about rates with debt funds or private lenders versus banks and credit unions, first thing we're noticing, banks and credit unions are focused on existing relationships. You know, previously this year they were sort of open to newer relationships, but were coveting deposits. It seems more and more that they're not open to new relationships and they're focusing on existing relationships. Banks are setting aside more and more money for loan losses. There was a report out today that JP Morgan, B of A, Wells Fargo, and Citi wrote off about $5 billion of loans last quarter, and they're going to continue to do that through 2024. So, you know, banks and credit unions, they're in a tough spot. They've got a lot of regulatory issues and criteria to meet. So, you know, they're going to be focused on making good loans to existing borrowers and you know, potentially selling off some of the troubled loans on their portfolio. This leads us directly into the second bullet point: private lenders getting choosy. With banks and credit unions sort of on the sidelines for new borrower relationships, more and more borrowers are turning to private lenders, debt funds, family offices, that sort of corner of the market. And so these lenders are seeing an increased supply of loan opportunities, which is allowing them to be choosier in this market. So, you know, they're focused on, you know, the higher quality deal, the higher quality sponsor, better location, potentially lower leverage. So they're benefiting significantly from some of the conventional lenders sitting on the sidelines. Last bullet point: capital following meticulous underwriting process. This is probably true for all lenders. You know, lenders are just becoming more and more conservative. They're focusing on borrower experience, liquidity, net worth, and, you know, some parts of that underwriting where they might be a little loose or, you know, overlook certain data points. They're really honing in on them. And then when it comes to the property, really underwriting in extreme detail the property cash flow, right? So if a borrower brings a property with X% rent growth, you know, really digging into the market, is that rent growth actually achievable? Where are the comps? Are there even comps that have traded recently? You know, and then as far as the expense side, and that'll bring us to our last bullet point. You know, expenses have, in some markets, in some projects, grown faster than rent, right? Most investors will put 2, 3, 4% rent growth and 1, 2, 3% expense growth. Insurance is a massive, has been a massive sort of thorn in the side from an expense standpoint, especially if you're on the coast. You know, Florida, California, a lot of these markets, insurance premiums have sort of gone through the roof, and it's really hurting property cash flow. So, you know, lenders are really digging in on cash flow and ensuring that, you know, what is presented is accurate and achievable.
Right. Yeah, I will echo that sentiment. In Florida and California, both, we're hearing reports from insurance brokers on a hard market, which is a technical term for insurers pulling out, rates going up because there's less competition for reinsurance of those policies. And in California, it's fire, and in Florida, it's water. And so fire and water wreaking some havoc in real estate underwriting for both multifamily and commercial properties at this time. So yeah, sentiment for sure, Chris is right that you did not see many investors really underwriting that expense growth outstripping their rents. And that's a double whammy to a property's value as underwritten, because we have expanded cap rates here as well. So how do we look for the months ahead? And back to our question that was key here, what is this capital waiting for?
Yeah. Well, there's certainly a lot of capital sitting on the sidelines. A lot of lenders we've sort of noticed that they're either full on their allocations for the year, or they might be full with a certain asset type, right? So a lot of lenders given the troubles in the office market, retail market have leaned heavily into multifamily, industrial. So we're noticing more and more lenders are sort of full in their multifamily bucket or industrial bucket, and they may not be looking for exposure to other asset types. So for primarily for the remainder of the year, these lenders are either not putting money out or just focusing on loans that are ready to close before the end of the year. Most are sort of trying to formalize their lending game plan for 2024. So we're seeing that more and more. As far as rate hikes, I think the consensus is we're probably done with rate hikes. There's been several reports that came out a week or two ago that said there was a 0% chance of a rate hike in December. So that is certainly promising news. We've even seen some of the larger banks and their research teams come out and say that they're expecting a couple cuts next year, 2 to 3 cuts, and then more cuts into 2025. So that's great news from an interest rate and cost of borrowing standpoint. GDP, lower GDP expectations for Q4 in 2024. As we just mentioned, GDP revised up for Q3, which is fantastic. But most are predicting that estimates will come in sort of the low 1.5% range for December. And this is down from a report of high ones or close to 2% in late November. So, I think we're definitely going to be expecting a lower annualized GDP number for Q4. Slow start to 2024. I think we'll continue to see the winter extend into early 2024. There's a lot of capital on the sideline. Rates coming down. We're seeing deals start to happen again. Borrowers and sellers are becoming a little bit more realistic in their pricing, right? So as the cost of financing comes down and sellers maybe become a little bit more realistic with their valuation expectations, I think we're going to see transactions pick up. But at least at the beginning part of the year, I think everybody's trying to get their footing for the remainder of the year. And then lastly, note buyers amassing their chips. There's a lot of money out there looking for distressed opportunities. So that's sort of the demand side. And the supply side, you're going to see a lot of banks and credit unions that are going to be forced to sell notes to meet regulatory requirements, whether it's concentration limits, liquidity requirements. There's going to be a lot of these conventional lenders that have loans on their books, and they may not all be non-performing or sub-performing loans, but there's definitely a lot of money out there that's going to be sort of licking their chops, waiting for some of these loans to become available.
Yeah. As far as the equity capital that's waiting to deploy and acquire properties, I think there's been clearly this trend of waiting for sellers and their ask to come down to where buyers' bids have been. And I think that's starting to happen. I think that we're starting to see a limited amount of sellers that are avoiding a maturity default. They're avoiding a rate cap expiration that they know they can't weather and starting to transact. Whether that really holds into the end of 2024 versus we have some willing to take a loss or willing to take a smaller gain just to finish up this year and get out before the end of the year is going to be an interesting trend to see. But commercial property prices have been falling all year. And that is a big trend of what equity capital is looking for, despite what the debt markets are doing or not doing. They're waiting for lower commercial property prices, and I think they're starting to get them. So it's going to be interesting to see if we do have this interest rate stability in the first few months of 2024, if we do have a bottoming out of the commercial property prices. I think we see and investment sales brokers everywhere would really applaud this, but we'll start to see this resuming activity. All right. Well, as we look at getting deals done and how to get deals done in 2024, a new feature to announce on the StackSource platform, which is our launch of lender match score details. So we have an algorithm at StackSource that matches lending and capital programs to different deal opportunities. This is based on location, it's based on type of deal, it's based on the type of request, and you get very different lender matches deal by deal by deal. And we're now bringing more transparency into our user interface about those matches. So in addition to an overall match score that will show the top lender matches all the way through the bottom and how strong those matches are, expanding the lender on the StackSource platform now reveals not only the interest rate range for that loan program, but the responsiveness, the competitiveness, and a sweet spot match for that loan program for the given deal at hand. Now, each of these is going to be tailored based on the type of request. So it will reveal how competitive is going to take both interest rates and leverage and other deal points like prepayment penalties and other terms that you can find on the term sheet all into account. Sweet spot is really going to talk about the size of the deal and whether that's a sweet spot for the institution, and also whether the type of deal is something that they're competitive on in particular. So this is all available in the StackSource platform for existing clients, as well as new clients that are looking for capital options. It is launched for all senior lender matches as of last week. And we're happy to continue to lead the charge as the most transparent commercial financing company in the industry. So once again, we're StackSource. If you're not familiar with us and you stumbled across us on LinkedIn or elsewhere, we're expert capital advisors nationwide. We have closed just about $2 billion of financing across 46 states so far. Our job is to get the right fit into the right capital stack for a real estate investor to maximize their returns. And we do that with the most transparency in the industry. All right, if you're still with us and you have questions about the capital markets, what's going on right now, deal structures that you'd like to get answered live, go ahead and jump into those comments if you're on YouTube or LinkedIn. If you're watching this later and you want to ask questions about the capital markets, about financing strategy, you can email us at hello@stacksource.com. So with that, and with some comments coming in and with some questions that we received ahead of time, Chris, do you want to go ahead and man the question?
Yeah, we've got a couple questions that came in already. First one, are there any specific sectors within commercial real estate that are more or less affected by the current underwriting changes, and how does this influence financing availability?
Yes, so there's a couple of vectors of what is impacted by underwriting changes and rate changes today. First of all, office is a dirty word, as you mentioned, Chris, in that the value of an office building is really hard to determine right now unless you have a credit net lease tenant or you're in a particularly strong submarket that's seeing a lot of job growth. Multifamily is being really hurt a lot by these insurance changes. It's hard to get a multifamily insurance quote to match the one you had last year if you're a real estate investor right now. And so multifamily is seeing a lot of downward pressure, not only from expanded cap rates, but also from the rise of expenses like insurance. So those two sectors in particular, we're seeing a lot of headwinds to value. But you also need to look at location, right? So in markets where there's a lot of population growth and job growth, you're going to see more tailwinds, and you're going to see them weather the higher for longer rate environment, and you're going to see them weather some of the underwriting changes in the meticulous process that lenders are going through right now to vet. The last thing to look at is if you're a strong borrower with a lot of money, a bank may want to calm down their underwriting process a little bit more for you than they would for other borrowers. And so bringing a strong deposit relationship to those lenders is really still a catch-all to get the best foot forward from lenders. Yeah. Anything to add to that, Chris?
Yeah, the only thing I would add there, and it's more to your last comment, if the property is not super strong or the market's not super strong, we're seeing some lenders look at global cash flow, right? So not only does the property, maybe the property doesn't hit a 1.25, 1.3, 1.4 DSCR, but globally they might be super strong, right? They might have a huge portfolio, or they might have, a group of borrowers with a bunch of outside income. So if the overall story is strong, but the property itself may not be that strong, that may be something that gets it over the hump and gets it financed. So
Right.
We're probably going to continue to see that, and I think as markets open up a little bit more, rates come down, that might become a little bit more of the norm going forward. Okay, awesome. All right, we have another question. With capital allocations already full for the remainder of the year, how does this impact those seeking financing for new projects? Yeah, go ahead.
Yeah, well, I think we are beyond that point, except in a very low leverage scenario where a deal has time to close before the end of the year in 2023. And so I think this is more geared towards borrowers looking for quotes for financing for projects to start, break ground, get acquired in 2024. And the truth is, it's a difficult time of year to get lender quotes in general in December looking for 2024 because committees join and determine their lending strategy for the year around this time and starting in January. And that, I think, is particularly true for equity investors right now that decided at some point over the last couple of months that were pencils down before the end of the year or before some trigger. And so I think it's particularly difficult to get pref equity or other forms of financing lined up right now. And it may be easier come mid-January when you see equity funds and debt funds alike coalesce on their 2024 strategy, get a signal to move ahead and try to build to their pipeline. Anything else on that for you, Chris?
Yeah, I would say, overall in this market with rates, shooting up, coming back down, you got a really strong GDP number, but that's expected to come back down. There's still a little bit of uncertainty. Nobody's going to push the envelope and try to cram a deal in that they don't fully understand, or the numbers. It's not a super strong deal. So, yeah, I agree. I mean, most investors are going to sort of sit on the sideline, wait for things to play out, wait for the new year to start, get a better lay of the land, and then move forward. There certainly are some private lenders that can act quickly and close in 20, 25 days. So if you have those deals, happy to review them. But yeah, for the most part, we're seeing most lenders kick everything to early 2024.
Yeah. Well, speaking of those private lenders, whether it's a quick close or whether it's like a high leverage scenario that's not going to be supported by a bank, or you're not that type of depository relationship that can get a bank to move right now, Chris. Yeah. You mentioned private lenders becoming more selective. What criteria are they using to choose borrowers and projects?
Yeah, experience, liquidity. I think if I'm a lender and I have sort of my pick of the litter on deals, I'm going to put my money behind a really strong sponsor, somebody that's done this before, that knows what they're doing. They've completed several projects in that market with that asset type. So first and foremost, I'm picking the jockey, right? I want to make sure that they're super strong. Then I'll look at the asset, right? So I'll see, is it an asset that I like? Is it, let's say I'm specializing in multifamily, right? Is it multifamily, or is it mixed use, or, something that's a little bit outside my strike zone? I'm probably not going to jump on that one. Obviously leverage is huge, right? So if I have an array of deals and they're all sort of the same, but I see lower leverage deals, I'm probably going to jump on that deal. Pricing, pricing is sort of all over the place, and it depends on some of these factors, right? So, I certainly as a lender want to see a deal succeed and want to see a sponsor successful. So I'm not going to hamstring them, but I'm really going to put my money behind a really strong sponsor in this market.
Yeah, makes sense. And I think betting on the jockey is a common strategy for private lenders, unless you're a private lender that has the adverse strategy of betting on, I kind of hope they default because I want to own that asset at a lower basis. And and I think you see debt funds with that contrary to the sponsor's best interest strategy start to come out at this point as well.
Sure.
I think one thing that we didn't mention in the current underwriting and deal structure, because it's not affecting current originations much. But we're seeing an increase in foreclosures by mezzanine lenders that made mezz deals over the last couple of years. And they don't need to go through the same judicial foreclosure process that a senior lender with a lien has to go through in many states. And this is a state by state thing, whether there's even a second lien with a mezz or how it works. But it has been reported that there's been an increase in foreclosures by these mezz lenders. And there are a lot of mezz funds where you need to be careful. It's a double-edged sword. Private lenders as well with stretched seniors, because they may want to take over that asset at a lower basis than, and then they view common equity as a cushion of sorts rather than as a jockey to bet on. And so both strategies are out there. It's something to discern through as you're choosing and putting together your capital strategy. And it's something that certainly will benefit a less experienced sponsor to realize it's out there, and also to work with somebody more experienced in the capital markets, like a qualified capital advisor, Saxource or otherwise. Be warned as well if you're a less experienced sponsor and someone's offering you very high leverage based on what you can see above other lenders, because those sharks are out there.
For sure. Yeah. I mean, just as we're preaching, lenders are doing their due diligence on a sponsor deal. The sponsor needs to do their due diligence on the lender, right? Who are they? What have they done? Do they have a good reputation? All that stuff. It really does matter in this market.
Yeah. All right. Well, we've covered our material. We've answered a few questions that have come in. If you missed our live stream and you're watching this later and you would like to ask a question, once again, hello@saxource.com is a good way to get in touch with the team and a qualified capital advisor in your region. If you want to just check rates, our website's great, but reach out. We're real humans, love to chat about deals as well. And Chris, we'll see each other, but not on the live stream. So to our whole audience, I think we'll wish some happy holidays here in December.
Yeah, happy holidays. Happy New Year, everybody.